Today, the FOMC kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete.
All right, so when we look at the housing market crash update, as we're recording this in late March, with me today, I have the president of National Mortgage Funding, and I would call you an economic expert, but with us today, we've got Mr. Steve Frost back with us on the show. Welcome to the show, my friend.
Thanks, buddy. Good morning.
All right. Good morning. Good morning. So lots to talk about. The Fed just met on March 17th. There was a couple things that I want to go through today and talk through and get your opinion, Steve, on what this means for the housing market. Does this bring us closer to what the media wants us to believe, which is a housing market crash? Does it bring us farther away? Mortgage interest rates and a whole bunch more. So let's jump right into the video. So I've got a recording of, the Federal Reserve, the Chairman Powell, and what he said about the Fed funds rate. So let's start off with that, Steve, and then because he talks about keeping the Fed funds rate at zero. So check this out.
Today, the FOMC kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete.
So, Mr. Frost, what do you think about the Federal Reserve coming out and saying, hey, we're going to keep the Fed funds rate near zero?
I mean, that obviously it's important. And it's important too, to remember what the Fed funds rate is, right? Because he mentioned two things there. He mentioned, I think the word is like substantial asset purchases and the Fed funds rate. So the Fed funds rate is like what companies borrow money from banks and the government to make to clear payroll, maybe like overnight, right? So it's very, very short-term borrowing. So that way these companies aren't paying a lot of interest and it's just keeping more money in these companies' pockets. The end goal of giving them more ability to give it to the consumer or the employee, which filters into the economy, right? But being a mortgage guy and being a consumer, and like most of the people that are watching this probably, unless, we have a giant like CFO of mega company audience out there, that like needs that lending, but those asset purchases are what are huge for us.
Yeah, and we're going to talk about how that relates to mortgage interest rates. We're going to talk about how that's going to affect the housing market. And so there was a couple other key things that that Powell talked about. So the other thing that he mentioned, Steve, was, I think it was 2 minutes into his press conference that he talked about the housing market making a full recovery. Listen to what he says here, and we'll kind of talk through it.
Housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up.
So, it's funny, as the media continues to talk about doom and gloom, housing market crash 2021, you have the leader of the Federal Reserve coming on national television talking about, from their perspective, the housing market making a full recovery. Now, you and I are going to get into the numbers here in just a minute, but what are your thoughts when you hear him say that?
I think it reinforces the position that you and I have shared the whole time, where I don't think there's going to be a housing crash at all. I mean, the position we're in now, everybody's comparing things back to like 2010. And the world is so much different than it was in 2010. Back then we were talking about like manufacturing, right? Being this big part, which we'll get into later, like the GDP, where this manufacturing is a big thing, where here we are 11 years later, and a lot of the GDP comes from things that we're buying that are made overseas, but marketed here and services here. So, to me, it's a totally different recovery. And people love in the media, the media, how it all works. People love doom and gloom. I mean, that's what we want to read. Like, who's hurt? How much better does it make me feel? You know, like that's what you want to read about.
Well, that's exactly right. And that's why you and I continue to make these housing market update videos, is to give the people who watch these videos the facts. There's no emotion. There's no rhetoric, which is your favorite word of 2021.
Figured that one out.
Yeah, it's all just the facts. So, you know, great point. As you talk about GDP, listen what he says about GDP.
Communities. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up notably since our December summary of economic projections. In commenting on the stronger outlook, participants noted progress on vaccinations, as well as recent fiscal policy. As with overall economic.
So GDP, you know, when he talks about where we're at, to your point, you know, I don't think it's as bad as people make it out to be. Would you agree?
I do agree, 100%.
You know, and the other thing that he talks about, one of the main driving factors of I think the media, as it relates to a housing market crash in 2021, Steve, is unemployment. And what do those numbers look like? And people having the fear that they can't pay for their mortgage, which we're going to talk about all those numbers. But he talked about in the press conference about unemployment rates. And I think this is important for the people watching this video to understand the facts where we're at with unemployment.
Employment rose by 379,000 in February, as the leisure and hospitality sector recouped about 2/3 of the jobs that were lost in December and January. Nonetheless, employment in this sector is more than 3 million below its level at the onset of the pandemic. For the economy as a whole, employment is 9.5 million below its pre-pandemic level. The unemployment rate remains elevated at 6.2% in February. This figure understates the shortfall in employment, particularly as participation in the labor market remains notably below pre-pandemic levels. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 4.5% at the end of this year and moves down to 3.5% by the end of 2023.
So, you know, the reality is unemployment, and you pay probably closer attention to the unemployment rate than anybody that I know, because it has such a heavy correlation to mortgage rates. But what are your thoughts on unemployment rates getting better?
We will see them get better, but one of the things that he mentions in there that's often missed with unemployment numbers, the unemployment numbers are high, but he also says that participation in the employment in the labor market is also low. So while the unemployment numbers are low and they're not coming back really fast, and that's because people have options, right? Like you don't have to go back to work. Like you can say, I'm afraid of COVID-19, and between mortgage forbearance, which we can dip in on, and the different unemployment benefits. And then, I mean, I have somebody I know, they have 8 kids and they just got the stimulus check. They walked away with 15 grand, like a springtime bonus. They went on vacation, everything. But the one thing that they talk about though is participation. So all these incentives that you have out there, all these things that you're getting from the government monetarily to continue to support the economy while we're in a pandemic, is taking participants out of the labor market. So people are not actively looking for jobs. So of course the unemployment, if the unemployment rate was high like it is now, and there is heavy participation, that means that unemployment's down and no one's hiring. But we have unemployment down and a lack of participation. Everywhere you go, everybody's hiring, you know? So it's kind of an interesting cross section, you know?
Yeah, it's like the chicken or the egg right now. But, you know, I think that the concern that the markets have is that people are unemployed and can't make their mortgage payment. As it relates to the housing market crash, this is what the media is like hanging their hat on, that's going to cause this huge housing market crisis. But all the numbers don't say that. Now, the Fed, I would say, I don't know, probably 50, 60% of the Federal Reserve meeting had to do with inflation. So let's see what he has to say about inflation. We'll kind of talk through that, and then we'll transition into what's going on with the housing market.
Overall inflation remains below our 2% longer run objective. Over the next few months, 12-month measures of inflation will move up as the very low readings from March and April of last year fall out of the calculation. Beyond these base effects, we could also see upward pressure on prices if spending rebounds quickly as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transient effects on inflation. The median inflation projection of FOMC participants is 2.4% this year and declines to 2% next year before moving back up by the end of 2023.
All right, what's your take, Steve, on inflation and what he's saying here that people need to really understand?
So what he's saying is that, the Fed, they keep the rate low, right? And then they also are making these asset purchases to keep inflation low, right? They want to give people money to spend, and they want to keep the price of goods low to inject money into the economy, right? They want to put gas on the fire. They want to keep this thing rolling. What he's saying is that, number one, you're going to see some increases in inflation, and the reason that he's trying to reinforce the markets and let everybody know, like, hey, we're still going to participate because this 12-month average of inflation is 100% going to go up. We are aware of that, but the reason it's going up is because two really bad months are falling off, and just as happened, and we were talking about this yesterday, is just as it happened a year ago, we had the same amount of stimulus through two different stimulus packages that went through with the previous
administration.
So they had the same thing, and the interest rates went up, inflation went up, things got great going into last summer, right? Like things were really starting to come around. I remember me saying, I think COVID disappeared. All these things happened. Summer was booming. And then again, as all of that stimulus started to peter out, people started going back in and cases started rising, we fell back to these recessionary levels. And the Fed is looking for that to happen again, potentially, unless it really starts to, that inflation rises and it stays there and manufacturing really picks up, because there's tons of shortages right now that are going to cause prices to go up. It's not because people are making more money and like a natural inflation and spending more money. It's because we can't get chips from overseas. Like I saw today that Chrysler's shutting down 5 factories for a month or 2 or 3 weeks or something because they can't get chips to make their trucks. There's a ship that ran aground in the Suez Canal that's going to take weeks to get all of that product back into these markets. So the Fed's trying to tell people, hey, look, inflation 100% is going to go up. It's going to happen, but we're not changing any of our policy until it's sustained and it makes sense. Like it's there for the reason that inflation should be there.
Yeah, I mean, well said. I mean, you nailed it. I mean, you talked about the bottleneck, of people delivering on these goods and these services being a massive issue. So let's transition into the housing market and what the Federal Reserve meeting in March, Steve, how that impacted the forecast of the housing market here in 2021. First and foremost, let's talk about mortgage rates. So with the Federal Reserve coming out and saying, hey, we're going to keep the funds rate near zero and unemployment numbers coming out, how is this affecting mortgage interest rates?
So we're starting to see for people that have been in the industry for a while, we know that rates never stay low, right? Everything's a cycle. And so just with some of the employment numbers and some of the vaccination data that we're seeing, rates are finally starting to make their way up. We've seen like a quarter to maybe 0.3% increase in rates just over the last, I would say, like 6 weeks. The majority of that came in one day. It was a wild one. And I think that, we probably will continue to see rates rise at a slower pace as the summer progresses, with, again, following all the experts' forecasts, seeing rates probably come down again in the fall. But not massive changes, right? You're talking like an 0.08% on a mortgage rate, which is not that big of a deal. It shouldn't stop somebody from buying a house. It's still historically low. And property value, the property values and people's equity is at an all-time high. So there's tons of cash out opportunity, still at really great rates. So that's, as far as my rate forecast goes, what I'm seeing, rates are going to go up a little bit. It's just a function of investors don't believe the Fed. They're like, we see all
That's
these
right.
signals. I know
Yeah.
you're saying this, but we're out. We're heading
Yeah.
to the stock market, going somewhere else type of thing.
And so that's that right. What you just said was the thing that drives has a huge correlation to mortgage interest rates. Is where are investors putting their money? Are they putting it into the stock market versus the bond market? And to your point, even with this is another thing the media just loves, right? Rising mortgage interest rates, freaking people out. Right. And putting this into context, you and I talked about this, I think, on another episode. A change of 0.08% in mortgage payment. I mean, what are we talking about in dollars and cents on just a traditional 30-year mortgage, roughly?
$20 to $30 a month.
Okay, so that's the reality. Everybody watching this, we're talking about $20, $30 as it relates to mortgage interest rates going up. Now, let's talk about the home sales. So home sales in February were down 6.2%. Again, media has an absolute frenzy. See, it's already starting. The home sales are going down. Let's put some context around what happened. Home sales go down, Steve, 6.2% in February. What does that mean in numbers? 775,000 homes were sold, which were up over 9% from this time last year in 2020, when nobody was talking about a housing market crash. So we're up year over year. We were down from January. Now, you and I talk about this all the time, but here's the key takeaway. Home sales down. Could it be because possibly inventory is also down another 30% year over year? Let me put this into context, Steve, and I want your thoughts on this. This is insane. As of March 23rd, at the end of last week, we were in the United States, across the country, maybe for the first time ever, I don't know that for sure, under 1 million homes for sale. It dipped into the high 900,000s. Now, put this in perspective. This time, early 2020, we had over 2 million homes for sale. So think about this. We've got under 1 million homes for sale right now. 775,000 are selling. We almost sell out every single month, which is why home sales are down, because there's no homes for sale. What are your thoughts on the home sales?
I think everything you just said contributes 100% to why there can't be a crash. So
that's right.
The reason that a housing market crashes is because you have no incentive to sell your house, right? Like, things are bad. Like, you can't make your mortgage payment. You're in forbearance. You can't get out of forbearance. So you walk away from your home, right? But because you can't, the only reason you ever walk away from home is because there's nothing there, or you owe more than what it's worth, which is what happened before. But I think home prices are up, 15% or something year over. There's less than 1 million homes for sale. The average days on market is the lowest it's ever been. If you can't make your mortgage payment, these people are not going to walk away from the money they have in their house, especially if it takes, if your house is literally listed and you've got a line of people down the street to come look at it and buy it.
That's right.
It'll create inventory. It'll create turnover, but it's not going to create a crash. Crashes don't happen when there's not enough homes for people to buy. That's just simple supply and demand.
100%. And this is the story month after month. As you and I continue to do these housing market updates, that's just the thing. I mean, it's just a supply and demand issue. People, on one hand, everyone's like, well, what does it look like? What are all these forbearances? We're going to talk about that in a second. Does that lead to a bunch of foreclosures? To your point, people can't make their mortgage payment. They have two options now that they've never had before. One is their equity position, to your point. They potentially could refinance, pull money out that can help them stay afloat while they get back to work. That's number one. Number two is the supply and demand issue. Anybody in North America right now puts their house up for sale, it's very likely that they're going to get multiple offers on that property with insane offer prices within a couple of days of hitting the market. That's our reality. So yes, home prices went up another 15% at the end of February. Let's talk about active forbearance. So at the end of last week, Steve, March 23rd, active forbearance numbers went down, not up. What does that mean to you? What's your takeaway on that?
People are coming out of it. I mean, and I talk to, like on the street, right? Like I write loans every day. I talk to people every day. I pull credit reports every day. You see a lot, you're starting to see people that are in, I've done loans for people that had a primary home and a second home, and they got put on, why can't I think of any words today where they were not laid off, but they were.
Did you eat your Wheaties
they
yet?
Took a couple, what's that?
Did you eat your Wheaties yet?
I did, man. I had a great workout. I did everything, but they were laid off, right? Like temporary laid off from work, and they put both of their homes in forbearance. And when they called the lender, he's like, I didn't even end up needing it because I got unemployment. I had this and that. Like I could have made the payments, but I didn't because it was nice to have the cash. Called the lender, and the lender just added what they forbeared, right? What they forewent in paying to the back end of their loan. The client made 3 mortgage payments, and we did a refinance on both of his houses for him. It made sense. The other thing to keep in mind is that when you go into a forbearance, as soon as you sell your house, the forbearance has nothing to do with you anymore. It's a loan paid in full. It has no knock on your credit. There's no delay in buying another house. There's no, you're looked at one way or the other because you did this forbearance. Once you sell that house, you can sell your house and buy another one the same day, right? So you can do a contingent sale if the home that you're selling is in forbearance, and you can move right into the next house.
It's so true. I don't know. Are you a fan, or do you know, you look at the Black Knight data at all?
No.
Okay. So this is crazy. So I just, this is one of the best data analytics, I guess, providers that I've really seen out there in the marketplace. And I'm trying to find this quickly, but over 50% of the people in forbearance have come out due to them, to your point, refinancing, paying off the mortgage, selling their home, or they're on a regular payment schedule again, which brings me to the next point, because at the end of March, 460,000 loans are due to come out of forbearance or renew. So it'll be interesting to find out, Steve, what happens with those almost 500,000 loans. Do they get into some additional type of forbearance, or do they get current? What are your thoughts on what's going to happen here the next couple of days?
So again, it goes back to getting those loans, the workout program, right? So a lot of those loans, they're just adding that to the back end of the loan. It will be interesting to see that, although even at 460,000 loans in forbearance that are set to expire, I mean, that in the grand scheme of things is not that big of a number. And those people that are coming out of forbearance have some options. The housing market and lending and the government, they learned a really, really hard lesson in 2010. And there are a lot of things in place that are going to prevent that from happening. So I don't think we're going to see this glutton of foreclosures. Will some of those foreclose? Yeah, for sure. There will be people that come out of forbearance and end up a mess. But foreclosures as a whole are way lower than they've ever been because of these forbearance measures. They're just natural foreclosure rates in the market that we have not seen because the banks are letting you not make the payments. So there will definitely be some foreclosures, and if anything, will be good for the market.
Yeah, I mean, I was going to say the exact same thing. I mean, if some foreclosures hit the market, it may help with our inventory issue, which is a massive issue. Maybe it helps to stabilize this inventory problem and maybe slows down the market a bit, but nothing like we saw in 2009, 2010, where, the vast majority of
3 million homes in foreclosures. I mean, you know what I mean?
Crazy.
Number.
It's not even, and maybe on the next episode, I'm going to pull up the data from Black Knight and talk through, the foreclosure ratios and what that actually looks like. Cause you're exactly right. You're hitting the nail on the head right now. The doom and gloom versus the actual numbers. I forget the number, it's like 6% potential foreclosure rate. It's like, okay, so 94% of the people are in good shape. It wasn't like we saw before.
Couldn't think of a less clicky headline than most people are doing just fine.
That's right. So
there's what I'm going to pass up.
Yeah. So let us know, you guys. We're going to, in the comments section beneath this video, what are you seeing on your side? What do you feel maybe that we're not taking into consideration for those of you that still believe there is a housing market crash coming in 2021? Because here's the reality. We're making this video at the end of March. We're already in April and things are looking great. So if the housing market crash in 2021 is coming, when is it coming? What is going to be the driving force? Steve, any last thoughts on your predictions for the rest of the housing market in 2021?
I know that I was listening to the radio today, and there's like another $3 trillion in stimulus already being worked out between like infrastructure and support for the American economy and everything. So, I think that this summer, I think that the housing market's going to continue to be crazy. I think rates are going to remain historically low for some time. I don't see the Fed changing the actual Fed funds rate. I don't see that changing until like 2024. I think that's going to stay low for a very long time. They're going to change some of their asset purchasing, which will hit the streets more than that, like on Main Street more than the actual Fed funds rate. But I don't think the Fed's going to make any really drastic moves for quite some time. I mean, we're in a fragile state, and we're in a position now where the government is really looking to keep things propped up.
I love it. I love it. So make sure you guys subscribe to the channel. We'll plan on seeing you guys at the end of April with another housing market update for 2021. Thank you guys so much for watching, and we'll see you guys next time.